morning, everyone. I'm Joanne Koontz. I'm here with my partners, Marina Parkin and Jackie Durham. We are back on a pop-up webinar to continue discussing the tax changes for 2020 and 2021, the Consolidated Appropriations Act. In case you weren't tired of the PPP EIDL alphabet soup that was comprising the majority of 2020, here we go with a little bit more to get us started for the new year. So we, as always, are recording this webinar and we'll be distributing it. So if you found it so riveting that you'd like to do it again, you'll have the opportunity to do so. Those are distributed by email to the attendees, also available on our YouTube page, on our Koontz Associates and Koontz Parkin websites, and on our Facebook pages. So if you have questions as we go, we're happy to field those. You can use the Q&A button at the bottom of the screen. That's a little bit easier for us to manage the questions than the chat box. So if you can, please use that. And if you have any questions, let us know. Without further ado, I'll let Marina get started.
Thank you so much, Joanne. And Jackie, thank you for joining us as well. I hope this tax information is exciting for you.
I guess if she hasn't quit by now, she hasn't quit attending by now. She's in for the long haul.
Well, I wanted to make sure that we give you guys a good recap of some of these potential changes that affect 2020, the tax season that we're going into for filing, as well as this coming year, 2021. I wanted to just say a couple of words about this particular legislation. So it's called Consolidated Appropriations Act, and I think it's just has to do with it consolidating thousands of other acts that were passed on during 2020 as a result of the pandemic and all of the other provisions and relief provisions. We had CARES Act, we had Families First Response Act, we had a slew of other things. So what this act did is add other new provisions, as well as corrected or extended or expanded the provisions that were already in effect by these other acts. So it's a little bit of an alphabet soup, because when they extend or expand something, the provision that you learned about, let's say something had 25%. All they did with this act is say, no, it's not 25, it's 50. And so it's almost like you have to go back and read the original legislature to figure out what the new rules are. Some things are retroactive for 2020, some things are prospective to 2021 and the next several years. So we have to be very careful in looking at the years that this impacts. Of course, this legislation is not just tax. It's a 5,500-page law, which I was listening to one of the guys talk about it, and he said it's like War and Peace 3 times.
Oh my gosh.
And let me tell you that I would rather read War and Peace 3 times in Russian and in English than read this particular piece of legislation. And I am sure that nobody that actually signed it actually read it or understands it in its entirety. So,
and nothing about that's new.
Exactly. And it's got $900 billion of spending money. So that's a lot of money for somebody to sign off with having to understand where the money is going, which it's absolutely incredible. Of course, the background of it is to provide relief and to businesses and individuals. So what a lot of the tax practitioners did is go through it with a fine-tooth comb and picked out the tax things. We did that even further. I went through a lot of the updates and picked out the things that I think will impact our clients, which is the individual small business owners. And that's kind of what I wanted to bring to you guys today. I also encourage you guys to send in questions. We may take questions as we go. If there's certain things we didn't expand on because we may run out of time, please email the questions to us. I'm Marina at koontzparkin.com. And feel free to email me after the webinar if we didn't address them as we go. We're going to try and kind of stop and take some questions after each topic. So the way that I broke it down logically is we're going to talk about some of the individual changes, then we're going to talk about some of the business changes. But a lot of them do cross over. But I think it'll just be easier for you guys to listen and send in questions as you need to. So Let's start by talking about the second round of stimulus payments, which is a big question that, of course, we get all the time. So the second round of stimulus payments, those payments are not as high as the first round. We are getting $600 per individual taxpayer, $1,200 for a joint return, and $600 per qualifying child. The phase-out limits to get those stimulus payments are the same as they were on the first round, which is $75,000 for single filer and then $150,000 for a joint filer. That's when the payment starts to phase out. So it phases out at a certain rate. So even if you made over that amount, you will still possibly get partial payments until it phases out completely. Let me say that they've started sending out the second round of checks. They're basing that amount on your income from 2019 tax return, because of course 2020 hasn't been filed. But essentially, the first round and the second round of stimulus payments are really truly based on the 2020 adjusted gross income. So what is going to happen? When you file your 2020 tax return, if you still qualified for those payments, that's going to be great. You're not going to get any additional payments if you already got them. If your income in 2020 was actually higher than in 2019, and you wouldn't otherwise qualify, but you already got those payments because they were calculated based on your 19, you are not going to have to pay that back. So again, I get that question all the time. I made more money, because we have a lot of clients that did make more money. They're in industries that did really well. They're concerned that they're going to have to pay that back, and you won't have to. So that it's not going to be a penalty to you. Now, if your 2019 income was higher and 2020 income is going to be lower and now you qualify, you're going to get those payments once you filed your 2020 return and establish that your adjusted gross income was below those limits. So that's the way that is going to work. So of course, we encourage our clients always to send in their stuff when it's organized. I do have to say in here that it looks like the filing season is going to start a little bit later in terms of IRS being able to accept returns. Typically, they're ready by like third week of January for those simpler returns, but they said that they're not going to start accepting anything until about mid-February. And I'm imagining it's going to be a little bit longer for businesses that have more complex forms. In any case, we encourage you to bring your stuff in. We can start working on it. And then when it's time to file and all the updates go through, your return can be submitted. So if you didn't, you can qualify for this stimulus payment. So hopefully that makes sense. Any questions on that, Joanne, Jackie? Do you guys get anything from your clients as questions?
Well, Renee wants to know when she can get her organizer.
Ooh, the organizers are that I see. This is fantastic. People are paying attention.
I can't wait to throw it away.
The organizers we're actually printing them as we speak. We're doing everything remotely again this year. So everything is going to be going through our portal system, and you're going to get an email with a link to the organizer and a quick little summary welcoming you to the new tax season. So here we go. So that's coming. I think I see Renee.
Welcome.
Renee is also asking if there's going to be an extension to this filing season. In terms of the filing due dates, this is a good time to talk about that. As far as we know now, we're still sticking to March 15th for businesses, April 15th for individuals, and the regular extensions are still available. Those are our 6 months extensions. So the business files an extension in March, gives them 6 months to September, individual in April gives them 6 months to October. And there doesn't seem to be any of those crazy COVID extension as we got last year. So I'm really hoping that we get a regular tax season. I was telling Joanne last year, I will never complain about regular crazy tax season ever again. So let us be done on April 15th and have a little breather before we turn our attention into planning and to extensions. Let's do that. The next topic on my list was the additional unemployment assistance. So that program was closed last year, and now they have reopened it. So you can get 11 weeks that start at the end of December going through March 14th of 2021. That weekly pay is $300 a week. So I think it's half of, I think it was $600 on that first round last year. So it's $300 per week if you qualify. Again, it goes through March 14th. still the self-employed sole proprietorship freelancers are still eligible for the second round of unemployment assistance. So if you are in a position to apply, please do so. I believe that I haven't heard too many clients who needed it, who had a lot of trouble once the system got a little bit better. I know at the beginning there was a lot of issues, but I feel like they've worked out a lot of the kinks, and as the volume subsided, it's probably a little bit easier to apply. But we haven't had any issues with clients asking us or telling us that they couldn't get in. So I don't know, Joanne, did you hear anything or talk with you know, Chris Sensitive with any questions or any issues on that front?
She sent an update to us, maybe to Jackie and I, maybe 2 weeks ago, just kind of outlining, but she didn't have any commentary about speed or efficiency.
Difficulty.
Yeah,
Okay.
no indication that like, oh man, this is impossible, good luck. It seems like that's loosened up and they've got their assets allocated to process things now. Of course, everything was such a big whirlwind back in March and April. So I hate to keep saying this, but now it's like people are used to coronavirus. So it's like, okay, now when you want to go somewhere, the first thing you do is check and see if their hours are modified, or if you need an appointment, or if you need a mask. Like people are conditioned to that now. So I think that now a lot of the systems have had an opportunity to work the kinks out when it comes to dealing with the volume of people.
And especially waiting, you kind of get used to that things are going to take longer, and it kind of becomes your new normal. Everything is still taking longer. Every type of service you get, everywhere you go, it's still taking a lot longer. So it's certainly kind of a new normal expectation. And
on my side of dealing with the IRS through the law firm too, we're still having difficulty reaching. Not all the departments are open physically. They're not all fully staffed. They're still not allocated their computer resources. So in the past, they would share a computer between 2 employees. They're not allowed to do that now. So people are waiting for the second computer to arrive. So whoever was working first is working, and the second person that shared that computer is completely unable to work on any files because they're not allowed to touch the same computer anymore. So everything inside the IRS is still wonky. You can be mad about it. You can even complain. It will not change.
This is a great segue to what I wanted to mention. Actually, I had that as an item for a little bit later, but I'm so glad you brought that up, because don't get me started, because this whole tax seminar is going to go sideways if I get going. But I do want to mention that the amount of IRS notices has been insane. These notices are repeats of the notices that have already gone out and may have already been addressed. By us, by the taxpayer called, or they wrote, or we wrote. And sometimes you get a letter to say, we've gotten your issue, thank you, we got it. And then 2 weeks later, you get a letter asking for the same money again. Please be patient. And we are, of course, on the receiving end of these notices, and we are the messenger, and we get killed all the time. I can assure you guys, we are doing the best that we can to respond to these notices. We respond to them timely. We try to communicate. Unfortunately, the letters get sent to IRS, and then it sits there unopened while the notices keep coming out. So the frustration in that, when last year, I remember they kind of put notices on hold, right, Joanne? They kind of put notices on hold, and they said, we're not going to collect. But the notices were still coming, but they kind of curbed the speed or the collection efforts. And that's not the case anymore.
Well, and they said they were going to stop the notices, but they didn't.
They did not.
And so then I was getting yelled at because really, hey, you said they wouldn't mail it. Well, that's what they told me. But whatever the shut-off button was not effective.
Correct.
Abort when they push the button.
And it's frustrating because these notices, after, let's say you owe them for prior years, you may have made the payment, they keep hustling you, and those notices look scary. There's a levy on your house, and there's a lien, and you're going to jail, and things like that. It's very frustrating. We understand it. All you can do is respond timely. I don't know that there's anything else that it's in your power. Every single notice that gets sent, even if you have to send a copy of your prior response, you get a certified mail, you get it in the mail, you have proof that you as a taxpayer have done all you could to respond to it. And then everything else, I don't believe there's really anything else that we can do about that.
We don't have a back number. We don't have any other way to communicate with them. So although that's frustrating, it's frustrating for us. You know, the practitioner priority line went away more than 10 years ago. So I used to have a back door, but that door has shut and locked. And
now it's the same. You can keep calling that number and it just keeps taking you to the same main line that everybody else is calling.
Yeah.
So
I will say, if you do have a notice with a number other than 1-800-829-1040, that's a great place to start. Although I have seen those not be accurate either. So I have called responding to the phone number on the notice and then been in transfer hell, like switched by 5 agents and then hung up on after waiting 2 hours to get the first guy. So because they're like, well, this isn't the right number. I'm like, well, it's the one on the notice. So
that's really all we can do, guys. So please be patient with us and be patient with them. And
if you don't have a number, try 1-800-829-1040. That's the main line. So if you don't see a number differently on your notice, or if you have a question, and there's a million prompts because they want you to hang up, but
and keep trying at different times of the day. We did find that also helps. Sometimes you call either super early in the morning or sometimes it's after hours. So that may sometimes be helpful, and just kind of, and be ready, be patient, be ready to sit on hold. So that's
I had one I called about 2 weeks ago, and I waited like 20 minutes and someone answered. I almost died and didn't get to talk to him. Almost died of shock.
Somebody's answering. See, this is the subject that we're so passionate about that we can derail easily. Getting back to the actual tax items, the next thing on my list was charitable contributions. This was a great provision in 2020, and they extended it to 2021, so it's really nice to see for itemized deductions. And if they don't itemize, they don't get a chance to take charitable contributions because their standard deduction is already at $24,000 joint, or $12,000 as individual. Now they get to take, in addition to the standard deduction, $300 for a single filer and $600 for a joint filer as an additional charitable contribution. So that goes above the line now, and you can definitely take advantage of that. Those need to be cash contributions, and like I said, that goes for 2020 to 2021. It has to go to qualified charity. So again, it's got to be a 501c3. It's got to be, you know, if you're helping out a friend in need or whatnot, if it's not going to a registered charity, it's not going to be allowed. Another great thing with charitable contributions, and this is for those taxpayers that give large amounts, and a lot of times they get phased out by an adjusted gross income limitation. So normally, if you do give large donations, you are limited to 60% of your income. That's the max you can give. If you give more, the excess carries over into future years. What they've done for 2020, and it got extended to 21 as well, is get rid of that 60% limitation. So you can actually give up to 100% of your adjusted gross income as a donation. And if it's still the donation is in excess of that amount, that excess is carried over into future years. But certainly they do want to encourage people to donate, and especially those donors that give a lot, they're now not limited, so they're able to really reduce their taxes if that's the case. Again, those have to be going to charitable organization. They cannot go to a donor advised fund. So essentially it's got to be almost like an immediate impact. It can go to a private foundation that's active, which means that if you put the money in private foundation funds other charities. So it's got to be something that's going to be impacted on a charity. If you give it to donor advised funds, which means at some point it's going to go to a charity, but not now, that's not going to work for this particular provision. So keep that in mind. But the charitable, it's going to be excellent. And I really do hope that they will extend it past 21, but we'll see. The next item is the educator tax deduction. as we know, for those of you that are teachers or whose spouses are teachers, teachers get 250 measly deduction off of their income. That again is not limited to itemized deduction limit on the expenses that they spend on their classroom. And we all know that those teachers spend all this money out of pocket. So it's the 250 deduction they get, it seems very, very low. It's a little sad for me that they did not extend that limit. What they did do is they said those qualified expenses can now include things to get your classroom ready for COVID rules. So any disinfectants, any wipes, and any other supplies, masks to keep the kiddos safe, but that still has to be fitted within $250. And I am, looking at my kids' classrooms and all the things that teachers, the school has done really well and the district helped too, but I know those teachers spend a lot of money. So we're into the still the $250 limit there. Next thing is the child tax credit and earned income credit. So child tax credit, the limit stays the same under Trump law. We had $2,000 per child. Earned income credit is a little funky calculation based on how much income you have and how many dependents you have. The idea here is that when you calculate the child tax credit, there is a refundable portion to it, depending on the level of income. Sometimes when your income is too low, you don't get that refundable portion. So what this legislature allowed you to do is actually use your 2019 income level to calculate potential refundable portion of the child tax credit. So instead of using the 2020, and then you may lose, if your 2020 income is too low, you may just lose the ability to get part of that child credit refunded. Now you can use your higher 2019 income levels to get that refundable credit. The key here is to have your 2019 information available. So for my existing clients, it's easy. You're already in my system, and the system is going to pick that up and give us the better number. For any new clients, or if you guys are switching CPAs, or if you are going from one TurboTax program to another and you can't roll things over, you need to have your 2019, some of the items input in there. So we often ask new clients to say, can you bring me your 2019 tax return? And they say, well, it's not going to look the same. It's all different income, all different items. I get it. However, when it's got certain things that do affect carryovers, it's important for us to see the numbers. You may not know what's in there. You may not know that you've got these carryovers, or some things are affecting the calculation for 2020, but they definitely do. So please make sure that your tax preparer has your 2020 or 2019 tax return ready. The next item on my list is the medical expense deduction floor. And this really is going to be seen a lot more by those that itemize deduction. So those that itemize, typically we start with, mortgage interest, property tax, high donation amounts, and then there is this other line item for medical expenses. Medical expenses get also further reduced because you could only take the deduction for medical expense of the excess over 10% of your total income. So there was kind of a floor that the medical expenses had to hit in order to get into the bucket of itemized deductions. Well, they have lowered that floor to 7.5%, which is excellent. So now potentially a lot more of your out-of-pocket medical expenses can get deducted because a lot more of it can go into that bucket and itemized. However, people with high income, a lot of times they say, you know what, my income was still high. I did not have a whole lot of out-of-pocket expenses. I know I'm not going to meet that threshold, so it's kind of useless. A huge planning point, and I think the clients forget that, and I have to remind people all the time, is health savings account. So what is a health savings account? If you have a high deductible health insurance plan, you are allowed to set up a health savings account. That is your ability to fund an account and then use the funds in there to pay for out-of-pocket medical expenses. What is the kicker here? The contributions to that health savings account are deductible. And they don't go into the itemized deduction bucket. They don't go into this medical expense out-of-pocket bucket. It is that contribution to HSA is 100% deductible from your adjusted gross income, which is excellent. The limit is $3,500 per individual account and $7,000 per joint account, and those limits change every year. I believe, for example, this year it's $7,100, so they up it a little bit every year to account for inflation and such. So that's potentially $7,000 of out-of-pocket medical expenses that you were able to write off of your income instead of shoving them into this itemized deduction potential ability to take it. And again, you have to have a high deductible health insurance plan. And the other nice thing with these health savings accounts is whatever you put in there, you don't have to use by the end of the year. So if you don't use it, you do not lose it. It rolls over into the next year. If you take money out of there that is not for health expenses, you have to pay tax on it. So it really is meant for you to take money out to spend on health. Questions there? I saw a couple of things pop up, Joanne. I don't know if there was any interest before we move on to the next item.
What is the deadline for contributing to your HSA?
April 15th.
April 15th. So,
yeah, April 15th.
Because you had, I don't want to get ahead of you, but I know some of the dates had changed on certain things, so just wanted to make sure that was still the same. Okay.
Yep, absolutely. And the nice thing there is you can make that decision before filing tax return. So we can prepare your tax return and then say, hey, if you contribute to HSA, it reduces your taxes by X amount based on your bracket or whatever the case may be. And then you say, oh yeah, great, that now I know what my tax benefit is from contributing. So these are all great things. And that's why you've got up to, and I believe you can set up the account after the end of the year as well.
One more question. Can acupuncture be paid for through HSA or like
yes.
other non-traditional?
Yep, absolutely.
Medical.
Yep.
Okay. And then how do you go about setting that up? Do you do that with a financial advisor or who do you do that with?
If you have a financial advisor, they can definitely assist you. But I believe if you go to a bank, most of local banks can set that up for you. I know a lot of people do those online. I don't know if they do it online with their bank or they just do it online but that's what I was talking to somebody yesterday and they said they had a hard time with the larger bank that they were with. But I said, I don't know, try maybe a local smaller bank if you have better luck. But if you do work with a financial advisor, they will definitely coordinate that for you.
I do know Sable Palm will do them, speaking of local banks. And then finally, can you pay your gym membership?
No, Anya, I see that question. No.
We don't want to be too preventative with our health now.
Exactly. You want to be preventative, but not too preventative.
Well, we'll pay for birth control, but we'll pay for the baby, but not the birth control. So any other non-covered medical expenses that insurance wouldn't cover, you can pay. Okay.
Exactly. And, vitamins and things like that, over-the-counter prescriptions. I think at some point they were not allowed, but now they're okay as medical expenses.
Cool.
The next thing that I want to mention is the debt forgiveness on the principal residence mortgage. So if you guys remember back in 2008, 2009, when short sales were all over the place and people had short sales and had bank forgive debt on their investment homes and principal residence, the law came out at the time to give homeowners a break from that and said, hey, if you've got a bank who's forgiving your mortgage and the mortgage is on your principal residence, we're not going to make you pay tax on it. So we're going to allow you to exclude it from your income. Well, that provision has been sort of sunsetted and revised and extended and extended and extended. And this particular legislature extends this provision now through 2025. So up until the end of 2025, you're going to be allowed to exclude forgiven debt from the settlement of your principal residence. The issue is that amount used to be at $1 million of debt. Now it's only $750,000. Okay. So that starts in 2020, going to 2025. And that's pretty impactful because I think that a lot of folks will be, we may have to go through that short sale depending on their circumstance.
Please don't remind me of the short sale.
Yes, that was quite
PTSD. I'm like,
yeah,
having flashbacks.
You do. Even now that we've been through PPP season, the short sales that's never going to go.
I gotta say, I won't say.
No. That'll be time to retire.
That's a different webinar.
Well, and you know, speaking of hardships, the next thing that I want to talk about is these coronavirus related distributions and disaster related distributions. So if you guys remember, a big popular provision under the CARES Act was the ability to take up to $100,000 from your retirement account without having to pay early withdrawal penalty of 10% if you're under 59, and the ability to either pay tax on that over time or actually recontribute over time. And the time frame was 3 years. So again, you could either pay tax on it over 3 years, or you can put it back and not have to pay tax on it, and you had 3 years to put it back. And that was extremely popular, and I cannot tell you how many people took money out because you had to be impacted by you know, COVID. Either you were out of job, or your hours were reduced, or you were sick, or family member, and things like that. So that was in effect for 2020. They did not extend that for 2021. Did not. So I was a little bit surprised. I fully expected that to continue because a lot of the disaster related provisions like that were extended. The corona related virus distribution was not. What they do have in the act is a disaster related distribution. So the rules are the same, but you had to have hardship related to a declared disasters. And they particularly said that COVID is not a declared disaster for this purpose. So I guess if you're in the area that's got earthquakes or hurricanes or whatever other natural disaster is, and that area is going to have a declared disaster, you've got, I believe it's like 180 days from the beginning of this tax law, Jackie. See, I knew she was here for a reason.
So I'm only here, not only taking notes about tax information that is interesting to me, but also in case PPP
this was
question.
The tax class.
Yeah. But you know what's funny about that? About them under this particular provision of the act, they're saying that the pandemic is not a disaster for purposes of this portion of the act, yet it is declared a disaster for purposes of the EIDL loans. Makes no sense. None of this makes sense. Absolutely. And also just want to reiterate real fast, since we're talking about distributions, that if you did take an EIDL loan, you can't make any distributions to your owners until that EIDL loan is paid off. And that's all I have for now.
Wow. Wow. I mean, it's amazing. This is what makes this all the more difficult, and this is what makes our job quite interesting. This is why it's taking a lot longer to get our normal work done.
Interesting is a euphemism, so you know, in case anybody didn't pick that up.
This is what is going on, and every single one is impacted in one shape or form. Yeah. Emergency financial aid grants. This is, I just wanted to make a quick note. If you, as a student, get the emergency financial aid grant, it is not considered taxable, and it also doesn't prevent you from taking the tuition tax credit. So that's great. It's not considered income for that purpose either. If it's given to you pending on you performing services like teaching or TAing or research, then it's not considered a true grant, and that becomes taxable income. But I think that's going to be pretty good. The next one is, speaking of education, is the education credit. So there's always been this American Opportunity tax credit, and there's a lifetime learning credit. The American Opportunity credit is really for undergrad studies, and then for graduate studies, you go into the lifetime learning credit. The nice thing about these credits is they're still in effect. The American Opportunity is $2,500 max, the lifetime learning is $2,000. The phase out for those to be able to take those credits increased. So if you are joint return, it used to be that you got phased out of being able to take that credit for your student dependent if you made over 160. Now that increased to 180. So you can still get that credit if you make over 100, or if you make under 180,000 adjusted gross income. Big planning point here for my high earner clients is been to actually move the kid out of your tax return, not necessarily out of your house, but maybe also out of your house. But the idea is to create a filing requirement for the student with enough income. So let's say if you're a business owner, you can pay your student kid salary, and maybe between your salary and some other part-time jobs that they have where they go to school, they can create enough income to substantiate being able to file their own tax return and be their own dependent. You losing your child as a dependent, because once they're over 17, the credit for a dependent is only $500. So you're only losing $500 in tax credit. But by creating their own tax return, they're able to shelter the $2,500 of tax by being able to utilize the credit, because their adjusted gross income is definitely under that limit. So this works a great, we do this with a lot of our clients, particularly our business owner clients that are able to put their kids on payroll. And I'm not saying give them, fake payroll or anything like that. This is definitely put them on payroll, make them do work, and pay them accordingly, whether it's annual or it's seasonal salary when they're home for the summer, or whether they're doing something. A lot of these kids are doing online stuff, especially now. They're doing a lot of the technology assistance in your business. So there's definitely justification for them getting enough salary, and for them to file their own tax return, they just have to prove that they provide more than half of their own support. So they don't necessarily have to provide the entire support, like, okay, you're completely on your own. But if there's enough income in there to justify more than half of their support, then they can definitely have a leg to stand on to have their own tax return filed. So that has definitely been a big planning point, and I think it's going to continue to be a great planning point. The next thing I wanted to bring up, and maybe Joanne can also see if she sees anything on the real estate side, is the eviction protection is been extended through actually just the end of January for 21. So I'm not sure if you've seen that with any of your landlords or anybody who's been using that, or, people have been pretty good, I think, about letting everybody stay who, wasn't able to pay.
I will say for my landlord clients, for the most part, people were proactively flexible about those situations, whether they were even in the commercial rent situations, which we're not required to do that. It seemed like people worked it out amongst themselves anyways. So I haven't we don't do landlord tenant here anyways. We farm that out to the litigator that we work with, but still a lot of times our clients will address the concerns to us before we pass them on. And I haven't had a lot of that come up.
Okay. Well, that kind of brings me to a good wrap up on the individual side. So I'd like to talk a little bit about some of the business provisions that are going to be impactful. The first one is this big thing that's been in all over the place, is the employee retention credit. So the idea with this credit was that if your business is either closed or partially shut down, or that your revenues were down, but you continued to employ people, you were able to get a credit against your employer portion of Social Security tax. The nice thing is that credit was going to be refundable because it was actually based on the employee wage. So you could get a credit up to $5,000 against your payroll tax, and you can actually calculate that credit more often than just on quarterly payroll tax return. You could actually get an advance on that refundable credit with every single payroll deposit. There was all these forms that were available, and people who used the payroll service were able to get that. So what happened with this credit is it got extended actually for the next 2 quarters of 21. So the first quarter and the second quarter of 21, the credit is still available. It also got expanded in that you can actually get the credit of up to $7,000 per employee. And it's not an annual limit now. It used to be, like I said, $5,000 per employee for the year. Now it's $7,000, up to $7,000 per employee per quarter. So that's going to get expanded, and it's really for those businesses that are still suffering, still continue to pay salary to their employees. So that there's definitely a lot more expansion. You also, if you're continuing to operate, you had to show that your revenues were down as compared to prior year by 50%. Now that is reduced to only 20%. So your revenue only has to be down by about 20% for you to be able to take advantage of this credit. The important thing to note here, and we really didn't deal with calculating this credit a lot for our clients, because like I said, if you had payroll service, they had all the numbers and they were able to get those forms filled out for you and do that on the quarterly filings. But the key here is that if you got a PPP loan as the business owner to pay for the wages, you couldn't also use these same wages to calculate this retention credit. So you couldn't double dip, and that ability to do so, it still continues into this particular year. So a lot of people are still using their PPP funds. People are applying for the second round or first round now. So again, you cannot double dip and cannot use the same wages to calculate payroll tax credit and also the forgivable portion of the PPP loan. There was also provision, which was the paid sick and family leave, where the employer had a mandate to pay for 2 weeks of leave for an employee who was either sick or took care of the family member who was sick or had to stay home because the kids' schools were closed. So there was a mandate to pay. It was $511 under certain circumstances and $200 a day under others, and they were able to get credit again of that straight amount under against their payroll tax, and that continues. The mandate goes away, so you don't have to provide that pay to the sick individual. So that was over last year. However, if you do choose to do so, you can still use this wage to calculate the payroll tax credit. Again, no double dipping. So if you're already using these same wages for employee retention credit or for PPP funds forgiveness, you cannot also get the paid sick and family leave payroll tax credit. Big one that I get asked all the time now is the meals deduction. So meals are always historically been only allowed up to 50% of the amount. Well, now it's going to be 100% for 21 and 22, and that's going to be meals that are provided by restaurants. So if you're going out to eat, you're taking out your clients, your business partner, like when I'm gonna take Joanne and Jackie out for dinner, I'm gonna be able to take 100% deduction for it. So get ready.
Means I can order better wine.
That's right. And actually get a tax break for it. Entertainment is still not deductible, and there's still a lot of articles that is really entertainment. And when you're taking out people for dinner, I think there's an article that says, aren't they being entertained? Well, it's really, the focus here is on meals. And meals, if you're out eating in a restaurant, you're able to definitely get a break. Again, your meals have to be reasonable. Just because now you get 100% doesn't mean that now it's time for you to take your family out, breakfast, lunch, and dinner, and you and your wife are in business together and you're talking about business all the time, because you do when it's a family business, you talk about business all the time. Still be reasonable. You don't want meals to be the biggest expense on your income statement, because you're not in the business of providing meals. And so just be reasonable.
You're not a food critic.
Exactly. Hey, maybe that's the next profession when we're tired of all of this. So definitely the meals is a big thing that we get quite a bit. Let's see, there was a couple of different credits if you also provided paid family and medical leave, and that's just, let's say somebody's on medical leave and you don't have a mandate. This is not related to the coronavirus medical leave. So if you are choosing as an employer to provide up to 12 weeks of family leave, let's say maternity leave, you're able to get the credit for that, and that has been extended and continues to be. The other important thing I wanted to mention is the net operating loss. So if your business generated a business loss, this is not capital losses, this is really a net operating loss. You, under the Trump law that got passed several years ago, you could only carry those losses forward to use against income that you were going to generate in the future. Now, because a lot of people had the losses in 18, 19, and 20. So these are the 3 years. This legislature opened up the losses to be able to carry them back. And if you carry the loss back to the tax years that had income, you're able to get the refund faster than waiting to generate income in the future and get reduce your taxes that way. So the loss carryback can provide a fairly quick tax refund. The carryback period also is 5 years, so that's also very generous, because if you think about even the tax rates that went down in 18, well, if you've got a loss in 18 or 19 and you can carry those losses back to up to 5 years, those 5 years ago rates were higher. So you're actually able to utilize the loss to get a tax refund in some of those higher taxable years. So that is great. We've done a few carrybacks before the end of the year, and there's really no, it doesn't seem like there's a deadline. The way we would do it is we would do an amended return, and we can amend the tax return, you know, up to 3 years. And so we can certainly do the 18, 19, and 20 loss carrybacks. If it's going to be a 2020 loss, we can carry that back using a simplified form. So when we are heading into the season now, anybody with losses, we're going to encourage to do the quick carryback form to be able to recapture some of those taxes. So that's a great provision. We're going to keep an eye on that for our clients. Qualified improvement property, that also has been kind of an issue back and forth. So if you have a commercial building that you've purchased, so you already have it, and then you're making improvements to it, as long as those improvements are not of the nature that extend or expand the size of the building, or putting an elevator or any other main structural components, if they're more of the internal improvements to get the building ready for your business and do some internal stuff like that, those improvements are now eligible for 100% bonus depreciation. So that was kind of a provision that was written badly, and then it just got cleaned up as part of this legislature. So qualified improvement on commercial building. Since we're getting close to the top of the hour, I wanted to run through just a very quick on the energy efficient stuff. So there's a couple of things on individual and a few things on the business side. For the individual, it seems like this energy improvement credit is still available if you put in the windows, doors, skylights, or roofs that are energy efficient. You can get 10% credit for those improvements. If you're buying furnace, boiler, things like that, water heater, AC, that is energy efficient, you get a dollar amount, which is up to $300 as a credit. So those are definitely still available. The other big one is solar. That also was kind of set to sunset, and it's been extended. So the solar credit started out as 30% of qualified solar property. Now it's down to 26% for 21 and 22, and then it goes down to 22% for 23. And as of right now, it goes away after 23 for residential solar, qualified solar improvements. On the business, you can also have the solar credit for improvement down to the business property. It's a little funky in that it's a little bit of an alphabet on, it's important to begin the construction or the improvement, but also place it in service. So you can't just start it before the credit runs out. You actually have to place this property in service. And so the credit, you have to start the construction, and you get 26% also for the qualified solar improvement on business property for 20 through 22, and then the credit goes down to 22% and then down to 10% subsequently after that, and then it sunsets after 25, the 2025. So those are some of the great things that are available on the energy side to make improvements to the residential and non-residential property. I think those were kind of the main things that I wanted to mention. We do have a summary of this stuff that we will distribute, and we will post that on our website. There's a couple of other provisions that were not as important, you know, beyond the scope sort of this. But you guys are feel free to peruse this, and this will be recorded as well. So feel free to listen to this again.
Yeah. And if you really can't sleep, you feel free to read all 5,500 pages. I promise you won't need Ambien. That'll fix it. You'll be sleeping in no time.
That's true. That's true. Any interesting questions, Joanne, that have come up here?
For real interesting, or like the law is interesting?
The snide, more like snide remarks. I see some smiley faces popping up.
That's right. Lots of thank yous from the participants. I think we have batted the questions as they've come, so I don't have anything this minute for you. Kind of last call if anybody has anything. If you find something, you know, later on, like Marina said, you're welcome. She's Marina at KoontzParkin.com. She's Marina at MarinaLovesTaxChanges.com.
Yes, I better buy that domain as well. Well, and you know, it's important for you guys to keep in mind that when we prepare your tax return, we take into account all of these changes. And it's amazing to see that people think, well, okay, well, it's a software, you know, but some of these things are press the button. Does this apply to this particular taxpayer? And also the ability to plan and say, you know what, this tuition tax credit is fantastic, but who's going to think to you know, move your kid out as their own standalone filer, or give you advice about the HSA contribution, or talk about the retirement plan. And a lot of the provisions from the Trump Act are, of course, still in effect, because that is still very much in effect through 2025. One of the things we always get, well, what's going to happen to tax rates? There has been nothing in the talks yet about increase in tax rates or change in capital gain rates. So we're keeping an eye on all of those things as we're getting into our 2021 filing season. But so we've got this tax act and these provisions along with all of the other old provisions to take into account. And it's not just, you know, oh yeah, you populate the tax return and it's there. All of these things, especially the new things, you have to think about whether they even apply. Once we figure out that they apply, I can push the button. But if it doesn't apply to you, it does you no good. So just be patient with us. It will be, again, another long season in terms of the turnaround time will still be slower. There's a lot of changes, a lot of new forms. So you just have to be patient like you are with everything else. And we're working, we're doing the best that we can under everything that I just talked about.
Well, and the thing is, it's not just the rules that you're accustomed to after 20-something years of doing this. It's the old rules from last year that we're now accustomed to, plus these new rules that just dropped as a lovely holiday gift to you. And we're anticipating more changes as the new administration gets off the ground. So what it is today is not what it's expected to be at the end of the year. So the whole year is going to continue to be more changes. So by the time we actually file a 21 return, it's going to look different than what we see today. We don't know which pieces and parts, but you can pretty much guarantee that every administration change, there is the old dog and fire hydrant proverbial situation where they've got to make changes to the prior administration's tax changes. So we're busy every 4 years, no matter who wins.
That's right. No matter who wins. That's right.
So thanks so much for your time, everyone. We hope you have a great weekend, and we will see you next Tuesday.
Thank you, guys.